Hello everybody, welcome back to Alpha Action. I got some news for you right here. As this channel has started to change, we have started to add on new things. So one of the new things that we want to add on is long form interviews and such. And so it's of course going to take a few months, but we want to actually start interviewing other traders and add that onto our channel and have long form interviews. Another thing that we're also starting is that we are starting a trading service. And so you can join this trading service on Teachable. I'll have a video coming out within the next 24 hours giving you a link to the Teachable classroom where we answer all your questions, where we teach you how to trade, whatever it may be, futures, options, technical analysis, fundamentals, statistical analysis, whatever you may want to learn. We give you newsletters, and then we give you a daily video. And so right here, I'm actually just going to be doing a sample of that daily video and what it may actually look like. And so if you guys are interested, just subscribe, like this video, go outside the comments section. And so let's begin. So first off, I want to touch base on the macro. So of course, everybody knows what's going on with coronavirus. I really wouldn't have to talk about that. And most people would also know what's going on with oil, with Russia and Saudi Arabia. And so Russia and Saudi Arabia didn't really like the fact that the United States was they were producing oil in an uneconomical way, and that there was a large supply being flooded. And so the United States produces oil for about 30, 40, sometimes even $50 a barrel, and it's very uneconomical. It is the expensive way of producing oil. While Russia will do it for only $20 a barrel, Saudi Arabia can produce oil for $15 a barrel. And so, because it's so uneconomical in the United States, the the American companies went into debt that they got to then go and build these wells and start drilling oil. And if it weren't for that, if it weren't for the large supply that's coming from the United States, if it were not the fact that the United States is the largest producer of oil in the world, then oil prices would be a lot higher. You know, more than double what they are, more than triple what they are, more than quadruple what they are. I don't know how high they'd be, but a lot higher than they currently are. But it's because the United States is the largest supplier of oil in the world, but they do it in such an uneconomical manner where it costs so much to drill just a barrel of oil. And so Russia and Saudi Arabia came out, and their hopes was that the oil, price of oil would go down so much that so many companies would then go bankrupt. And so now these companies, largely located inside the United States, would go bankrupt, and that would then be followed by the less of a supply of oil, and so now the oil supply goes down. Now the United States is not the world's largest producer of oil in the world, and so they can then dominate the oil space, and they can produce oil cheaper also, and so it gives them an advantage. And so they don't want to keep oil down in the long term. They of course want to keep it up. That's the job of OPEC, but they're doing this in the short term to price gouge the Americans out. And so what's going to happen ultimately is that oil prices are going a lot higher. A couple of years from now, you're going to see you're going to go to the gas station, you're going to see $10 for a gallon of gas. That's going to be the normal thing. And so in the long term, they're going a lot higher. Just in the short term, the companies that have a lot of debt will go bankrupt. And in the short term, most American companies will go bankrupt. I will get into Chevron trade later, where I do think that we could try to use Chevron, a company that has fairly large cash pile that could withstand this, and we could try to benefit off of that with that. First, let's get to SLV because Trump talked about stimulus and there was fiscal stimulus. So there's monetary and there's fiscal. They already had monetary stimulus because they lowered rates. Lowered rates and the dollar got weaker. And they're already doing QE4 and the dollar is kind of weaker because of that. Then you have this fiscal stimulus that just makes the debt burden on the United States higher and makes the dollar even weaker. And so in the long term, what does this tell us? This tells us, and we've been saying this for a long time in this channel, this tells us that the United States is in a position where they have the choice of weakening the dollar and strengthening the market or they can let go of the market and let the market go down, but the dollar stays strong. They've chosen the former. They have chosen to let the dollar drop and let the market go up. And so what they're doing is that they're doing all this stimulus, which is good for the market, but it's terrible for the dollar. The dollar keeps on eroding because of this fiscal stimulus that they're getting through this deficit spending that they plan on doing, because of lowering rates, because of QE4, and because of what they plan on. They actually plan on doing more helicopter money. They don't want to call it QE. They don't want to call it debt monetization, but that's what it really is. And so because of that, the dollar is consistently getting weaker, and this leads to a long-term road to hyperinflation. Now, I'm not saying that's going to happen overnight. I'm not saying it's going to take a year. It's at least going to take a decade to 2 decades to really start seeing that, but it will lead to a road of hyperinflation long term. But short term, how can we take advantage of that? So looking here at SLV, I do expect a pop in silver because we've seen silver lagging behind gold. And so with silver lagging behind gold, it seems obvious. I think we would see a pop in silver. And the silver gold ratio is reaching record highs. And I think the old record high before this was decades and decades ago. And if you look on TradingView where I was looking, you don't even see it on the chart anymore. That's how far back it was. It was decades and decades ago. I believe it was in the 80s that silver gold ratio got this high. But silver gold ratio is at record highs right now. And that's a bullish sign actually for silver, because almost after that, almost all the time, the week after, the month after, 6 months after, a year after, you see silver go up. So here on SLV, we're looking out to June 30, 2020 expiration, and we want to be long the 1850 calls. So naked 18 spot 50 calls, take long positions in those. This is a riskier trade, a more speculative trade. I'd make this a smaller percentage of your portfolio. Simultaneously, you should go out and you should go on to the 20th, and you should, right after you buy that, go on to the 20th and do a leg in vertical, where you go on to the 20th and you immediately go and you sell the 20th with a limit order for the amount you bought the 1850. And so now you're creating a position where if you buy this for, say, 30, and then you go and put a limit order where you sell this for 30, then it goes up just a small amount, even though it might not stay there, but you get filled on the 20 and get it for 30, then it goes back down. Now you're creating a situation where, worst case scenario, you break even. And so it's called a leg in vertical. That's what we want to do right here in SLV. I would make this a small percentage of your portfolio, risk 2-3% on this trade right here. Another one we want to look at is TLT. And so if we look at a chart of TLT, which we could actually do right here, when looking at a chart of TLT, we'll see that it is essentially a blow-off top. And this also goes back to what we're talking about with rates. From a fundamental viewpoint, when it comes to rates, I ultimately think rates are going higher because higher inflation, all the stimulus that they're trying to do, the fact that people are coming into this thing that is basically a piece of paper where you are consistently losing 2% every year. The fact that people are willing to buy this is pretty insane. But we have started to see the fact that the higher inflation is starting to play on the bonds, because we've seen the yield curve actually steepen, not invert recently. So recently started actually steepen more and more and more. Trade based off that is just long the 10-year, short the 30-year, that you could definitely do to trade the yield curve. But looking right here, looking at the chart, you start to see that it starts to look like a blow off top. And so it's not with the same velocity that you saw with Tesla, because with Tesla, of course, it went up, and it went up a lot more in just a day. But again, you have to remember this TLT is a lot larger market. You can't expect the same sort of move that you would with Tesla, SPCE, or lumber liquidators. But straight up, and then from here it's probably going to go down, consolidate, or crash down, or trade sideways and then go up. But I don't expect to just rip up and keep on ripping up. But that's what I see with TLT. But yeah, overall, fundamentally, the dollar does not look sound. And so for those reasons, you do want to have a bearish view on the bonds and a bullish view on the yields because of the higher inflation that we are starting to face. And so here, looking at TLT, we want to go out. May expiration would be fine. And then we can look at the calls and puts. Just look at the mid price. Yahoo Finance always has a large bid-ask spread. Oftentimes doesn't even match the mid price. Just look at the mid price. Every broker has a different bid-ask spread though. Look at the mid price. Right here we have 12. Right here it's only 5. And so I checked on TD Ameritrade before. This is fairly accurate. And so what we want to do is that we want to go out of the money, short this right here, and we want to do a bearish risk reversal. A bearish risk reversal is just where you sell a call, you use a premium, collect to buy a put. Right here, calls trading a bit more than puts, so we can go out to the 200 strike, and we can short a call. And then going here, we can take long positions in a call all the way down at 150. The likely scenario is that it won't get down to 150 and it won't go up to our 200 strike, but they are equal distance from the current price. Actually, the 150 is closer. The 200 that we're selling is $30 out of the money, while the other one is only $20 out of the money that we are buying. But the likely scenario is that both of them will expire worthless, and it'll stay in between, and we collect the credit, the difference between the two, which is about 2% of the price of TLT. But I think this is a fairly risk-free trade. I would put a larger sum of your portfolio in this trade, somewhere around 7, 8, 9%. Looking here at GLD, all we want to do is that we want to go 2 weeks out. And what we want to do on GLD is that we want to take advantage of a calendar straddle. And so looking here at GLD, March 20, 2020, we have calls right here. And so, yeah, those right there and these right here. You want to short the at the money put and the at the money call 2 weeks out. And so you shorted a straddle from March 20, 2020. And then you want to go out to May. And then after going out to May, you want to buy the 158 again for the call side and 157 for the put side. And so when you do a calendar straddle like this is really good to take advantage of the inverted term structure. And so what is the inverted term structure? And again, this is what the service is made for. When we're going to be making service, if you have any questions like this, you don't understand anything that we've said, if you don't understand what an inverted term structure is, you can just ask us. So an inverted term structure is when we have this situation where in the front month, or well, with futures it'd be front month, with options on stocks it'd just be that the closer to expiration tend to have a lot of volatility, while the options far away from expiration have very little volatility, which is usually the opposite of what happens. But it creates a situation where we're able to do a calendar spread and we're able to buy an option that expires about 2 months or 2.5 months from now, and simultaneously sell an option that expires just 2 weeks from now and already make 50%. And so if you do this all the way and just do it again and again and again, you get a 5-bagger in just 2.5 months. And so it's a fairly conservative thing to do. I put 10% of your portfolio in this, take advantage of the inverted term structure. And so this volatile market tends to give us these sorts of things, and so that's just what I like about it, is that many people don't like volatile markets. I love them because they give you all these sorts of opportunities. They give you inverted term structures. It lets you do calendar spreads like this because you're selling options that have lots of volatility, buying one further out that doesn't have as much. And so it just lets you do an inverted term structure. Eventually you can just get to a long naked straddle, and you essentially got that for free, and now you got unlimited profit on both sides. Okay, looking here at UAL. So UAL, this is a long-term position I'm looking at. So for all of you long-term investors that were looking on this channel, this is for you. UAL is trading at 46.78, is trading for just about 3.9 times earnings, I would say. And so we don't just want to look at the price to earnings ratio. We also want to look at the risk on those earnings. PE doesn't tell you the risk of those earnings. And so we want to look at the risk. The risk right here is that this company doesn't make any money for the next 2 years. Will it be fine? Well, the way in which we want to look at this is that I looked and I saw they had a large cash pile and looked at the amount of money that it would lose relative to the cash pile. Total cash, about $5 billion. How much would it lose? Well, the max amount I feel that it would lose in the next 3 years would be about those $5 million, but I don't feel that it's going to lose more than that. And so over the next 3 years, I just don't see this company losing more than $5 million, even if it completely stops operating 100% because of the coronavirus fears. So this is a long-term position looking years out that you may want to put this in a very conservative position. And so just from a fundamental perspective, we have that. Now, from a supply and demand perspective, just asking yourself who is going to buy this, who is going to sell this, you've run across a situation where you almost have no more sellers left. You have Warren Buffett and Charlie Munger who've already started buying back Delta, who might possibly buy back United Airlines because they think it's cheap enough at this point. And you have these C-suite employees, like the CEO, CFO, COO, etc., who are already starting to buy it back. You run across a situation where they are now majority shareholders, the C-suite employees, the Warren Buffett, Charlie Munger, Berkshire Hathaway, and those people are never going to sell. Warren's never going to sell. Charlie Munger is never going to sell. They are long-term buy and hold investors. Of course, the insiders in the company can't sell, and so you run across a situation where it's very unlikely that's even going to go lower from here. So what we want to do is that we want to go out to January 21st, 2022, and this is great because you will not get taxed on this until 2023. So we want to do a covered call. We want to short the 45 strike, and so we'll try to get about $21 of premium if we can. If we can gouge it a bit, get 21 instead of 20 as it says that we should, then we would actually put this trade out and we do a covered call, buy 100 shares, short the 45 strike calls, expiring January 21st, 2022, not get taxed until 2023. And if the price stays the same, we make money. If the price goes up, we make money. If the price goes down, we make money until $25. And I find it very unlikely that it will go down almost another 50% from here. But it would have to do that. They have to go down to that $25 level for us to actually start losing money. And I find that very unlikely. And I find some smart money buyers starting to step in if it ever gets even close to that level. And so right here, you can put this trade on, and you can essentially get United Airlines for half of what it is because you're selling that call for a lot cheaper. And so you are essentially going to make a 100% return over the next 21 months on this trade. And so 21 months, 100% return, fairly risk-averse trade right here. I would put a large portion of one's portfolio, and this is actually, I would say out of all the trades that we're going over, this is the least riskiest right here. I don't expect United Airlines to go bankrupt. United Airlines tends to have a fairly good cash pile. It has good smart money backing it up, like Warren Buffett, who is willing to buy more if it goes lower. And this right here, it just takes advantage of this high volatility. Doing covered calls, especially years out when you have such high volatility and so many people are scared, so many people are buying these options, and so many people are speculating that's going to go up. That's why calls are costing more than puts, and that's why we're doing this covered call. That's a great way to take advantage of this. And on top of that, you also get the dividend. And so you can expect a 50% annualized return from this. It's a fairly passive, long-term trade right here. You just put it on and you just hold it. And so that's what we're expecting right there with UAL. Okay, right here we got Chevron. So when it comes to Chevron, what I plan on doing is a bullish risk reversal. So this is going to be the opposite of what we did on TLT. With a bullish risk reversal, we want to go out, and we can go out June expiration, and we want to short a put, use a premium we collect to buy a call. So I want to go and short the 65 puts, and we want to buy the 95 calls. So 95 calls right here, and want to short the 65 puts. And so right here, I just checked on TD Ameritrade. The credit collected would be about $30. Yahoo Finance did not update their bid-ask spreads because you can see right here on $95, you can see that the mid price is lower than both the bid and the ask, which never actually happens because this should be between the offer and the bid. And so that clearly doesn't make sense right there. But I checked TD Ameritrade, my broker, and they seem to be fine with a $30 credit collected for that sort of a trade. And the puts actually cost more when I looked at my broker. Every broker is different though, but Yahoo Finance, for whatever reason, they always have very skewed. But if you have a broker like Robinhood, you generally have larger bid-ask spreads, even though you don't have commissions. While if you have a really good broker like Tasty Trade or TD Ameritrade, they do charge you 60 cents an options contract. I know Tasty Trade is the YouTube channel. Tasty Works is the brokerage. Tasty Works charges you, I believe, $1 to get in, and it doesn't cost you anything to get out of the trade, but you get better execution over there, smaller bid-ask spreads over there. So depends on who your broker is. With TD, I would say they're one of the better ones. You tend to get fairly tight bid-ask spreads. You get a $30 credit that's collected for putting on that trade. Again, likely scenario, none of that's going to get touched, but you just collect a credit at the end of the day. And if it goes below that level, we definitely want to be owners of this underlying because then it would be very cheap. I think Chevron already looks pretty attractive, but when it gets down to that level, it really looks attractive, gives us a good margin of safety. So I want to be a owner if Chevron actually gets down to that level. But again, this is a more risk-averse trade that I'd be putting on. So the riskiest trades that we would have over here would have been something like the SLB. On the other side of things, I would say the UAL is probably the safest trade. This is somewhere in between. Okay, right here we have Citigroup. And so looking right here at Citigroup, we could actually look at the PE ratio. PE ratio is 6.3. And so again, right here, you have to ask yourself, can it weather the storm? It can. I went through and I did evaluation. And yes, in the short term, it will get hurt because of the macro, because of the fact that rates are going lower and that banks ultimately don't do good when rates go down and in low rate environments. But we are going to keep a position right here where we can try to profit if it does go lower. And so when it comes to Citigroup, I want to go out 101 days to expiration. So I think that would be somewhere around here. And so going that far out, what I would want to do is that I think I would want to short the 25 put and take long positions in the 25 call. And so right there, that gives us, or excuse me, the 75 call if I had said that. So the expiration, it would be June 19th. And so June 19th expiration. And so looking at June 19th expiration, I would want to go and short these right here. And so the price that I'm getting for TD Ameritrade for that is about 22-ish. And then I would want to take long positions right here. Again, look at your own broker, see how much their bid-ask spreads are. Yahoo Finance always has it skewed for whatever reason, but go and check with your broker. TD Ameritrade tends to have it fairly tight for me, and so it makes sense to go out and do that right there. But long the 75, short the 25, and puts do cost a bit more than calls right here. If you were to buy this, you would essentially be buying it at 3.5 times earnings if it went down. And later on, I think I could do a full valuation of Citigroup. And so that right there is our trade on Citigroup. If you have any questions about that, I could get into more details about it. Most of the time, I don't get too much into the fundamentals because many people don't understand it 100%. But if you have a question about it, go ahead, go into the comments section and ask me. Or if you're later watching this on Teachable because you want to sign up for the service that we're starting to offer, go ahead, ask us questions. We answer all the questions that you have out there. You can ask as many questions as you want. We answer all of them. We try to give you all the advice that we can. And so the very last thing that we're going to look at is BEDL. This is Vedanta Limited. And so right now it's trading at about 4.5, 5 times earnings. And so if we look right here, and the company only pays out in dividends, it pays out about a 6% yield, but that is only a very small percentage of a payout ratio of its total amount that it gets through its earnings. And so this creates a situation that we really find favorable, where we are in a situation where only risks a small amount of its earnings in its dividend, and so its earnings are fairly good, it's fairly diversified, and this is also macro trade in a sense because we expect that the Indian rupee will strengthen against the dollar. It already is, and so Vedanta should be doing good because of that, because the Indian rupee is strengthening against the dollar. And so for those reasons, Vedanta Gold or Vedanta Limited should be doing good. And so VEDL, just take a long-term position in that. Just buy the stock, take a long-term position in that, where you are going to long-term expect it to go up, and also you're expecting the dividend to be raised. And so again, take a long position in that because we're expecting the rupee to get stronger, and they are an Indian company, and so they are mining and producing revenue in rupees. They are a mining company that is not just gold, although I did say Vedanta Gold, it is largely gold. They offer many other diversified metals too, and I think as the commodity markets start to be likened a bit more, Vedanta will do better. So that's all I have for you guys over here today. If you guys want videos like this where every single morning I walk you through either a valuation of a couple of companies, or I go over some options trades like this, or I go over some macro, whatever it may be, we have a trading service coming up, trading advisory coming up, where we answer all of your questions. We offer a daily newsletter, we offer daily videos like this, and we offer trades, a trade roundup. We offer a watch list along with everything else, and all of that. Make sure you subscribe within the next 24 hours. Within the next 24 hours, I will have a video coming out of what exactly it is, of the cost um, of the teachable link to the classroom and such. And so within the next 24 hours, I will have a video coming out on that. So stay tuned. We'll have a trading advisory service. And again, I'm actually making this very, I looked at what everybody else has to offer. Nobody offers what we have to offer. And so that's why I originally decided to start this. Nobody offers a full watch list, not just a trading signal, not just a trade alert, a full watch list, a full fundamental analysis of everything, a full newsletter for the macro, full trade ideas like this, um, answering all your questions, not just with a small, okay, here's the trade, or here's why we're going to do it, actually teaching the concept or fixing any problems that you may have. This could be as simple as I think that the underlying is either going to go up a lot or down a lot, or I think it's more likely to go up. What should I do? Then I could tell you, okay, do a straddle, but instead of just saying that, I can actually teach you what that is, the implications of that, the payoff diagram, etc. And so that's what we want to do with the service. If you guys want to really sign up for the service, we will have the link to this coming up within the next 24 hours. I will make a video about this service, so you can go ahead and sign up for that. Within the next 24 hours, I will have a link for this service coming out. Thanks for watching, everybody. Until then, see you next time.